Hello, everybody. Welcome to another Reinvent Money episode with me, Paul Buitink. And today, instead of having an online interview, I have the pleasure to talk to someone in person. And that's Alfonso Peccatiello.
Yes, correct. Hi, Paul.
How
Pleasure
are you?
to be here. All good. Thank you.
Yeah, such a great opportunity to talk in person because you live in Holland.
Correct.
I'm Dutch. I also live in Holland. So it was a great opportunity to meet up instead of doing it online.
Yeah.
And we are here in a very special place.
True.
Could you describe where we are?
Yeah, we are at the restaurant called Due Sicilie. It's in Amsterdam and it's owned by friends, Luigi and Verdiana. Luigi is the chef and Verdiana takes care of the room basically and everything else that is not directly cooking. It's a southern Italian restaurant and it's probably, I'll take away the probably, it is the best Italian restaurant in the Netherlands I've ever tried over the years.
Great. So everyone should try to have dinner here one day in their lives. And I really want to thank them also for the hospitality and to allow us to record this interview here with, of course, a espresso.
Yeah, sure.
It's a bit too early for wine. Otherwise, we would have put a bottle of wine on the table. And what do we have here in front of us? It's also something special, I think.
Yes, this is an object from Puglia, which is basically the home country region of Verdiana. And it's a luck symbol. We have a similar one in Campania, where I'm from, close to Naples. It's basically a small object, a red object. You probably have seen it. This is much bigger, and it stands on the balconies of people, and it's supposed to send away bad luck and bring good luck to people from Puglia.
Well, we need some good luck because we're going to talk about some heavy stuff today. Also about the macro endgame, about bonds, housing markets. Also, we're going to talk a lot about Holland and about the situation here in terms of housing, pensions, the euro, all of that. So we need some good luck. But let's first discuss a few more personal, more lighter topics.
Sure.
Because you are Italian, living in Holland. What brought you to Holland? Was it love, work?
Well, if you grow up where I did, which is close to the Amalfi Coast, and then you graduate and then you look for a job, you soon realize that unfortunately it's a very tough job market. So it's a very good place for weather, food, wine, and friends and what have you, much less to work. So then I started looking for opportunities abroad and I moved to Germany first to work for ING, the Dutch bank. Soon I realized Germany wasn't exactly the place where I wanted to be.
Why not?
Well, for a bunch of reasons, but let's say Germans are not known to be very flexible when it comes to their mindset and approach, and people from south of Italy, they have this built-in flexibility when it comes to several things in life. So there was this cultural clash, let me call it like that, which led me to think, okay, let's see where I can go next. And then I realized the headquarters of ING were in the Netherlands. So I moved basically to the headquarters of ING. And I started working here and I realized, after a few months, actually, this looks a bit better. Fits me probably better than Germany and ended up staying here ever since. So since 2014, basically.
Yeah, and before you started your own firm, you were responsible for something like 20 billion
Correct.
In assets. Could you describe a bit more what you did at ING?
Yeah, so I started there as a portfolio manager in the treasury department. Banks, European banks, also American banks, since 2013, if I'm not mistaken, are forced by the regulators to own a large portion of their balance sheet in liquid assets because of a regulation called liquidity coverage ratio. So after the great financial crisis, regulators decided banks had to own liquid assets on the balance sheet. These liquid assets are mostly bonds, right? So you need to manage a large portfolio of bonds nowadays if you're a bank by regulation. And so I was a portfolio manager at the beginning when I started contributing to managing this portfolio. And then after a couple of years, I was promoted to run a large portion of this portfolio by myself with a team of people for ING Germany. And that's the $20 billion portfolio I was running, which was then mostly bonds, but also credits. And at the end of the mandate, even equities.
For ING itself or for customers of ING?
No, that's for ING itself.
Yeah. Interesting. And when did you stop and why did you stop working at ING?
Well, I stopped in December last year. So my experience there lasted about 7.5 years. And as career went very quick, and I'm very grateful for that. I learned so many things and I had so many interactions with high-level stakeholders, prime ministers, central bankers, strategists at Goldman Sachs or whatever other investment bank. But at some point, the learning curve was starting to flatten out a bit. And also I wanted to experience something where my knowledge could be, or the learning journey I was going through basically could be shared with more people out there effectively. I started being more active on social media, posting on LinkedIn to start, and really started enjoying the interaction with people and the back and forth and the comments. And so at some point I realized, well, maybe I would like to make a wider use of my knowledge and share my learning journey with more people than I'm doing now.
And then you started the Macro Compass.
Correct. So I started this free newsletter where once a week I publish macroeconomic thoughts and even investment ideas on the newsletter. The idea is to try and convey some financial education, which I think in most cases is either partial or right away incorrect. And I would like to give more people the possibility to learn how to read macroeconomic developments and connect the dots in global macro, which is a very interesting thing to do. And in most cases helps you as well protect your purchasing power over time.
Yeah, that's great. I love your newsletter. I read it every time, and I'm therefore also really happy to have a chance to talk to you in person. But a huge step to have this very comfortable job with good benefits, and then all of a sudden being on your own, with of course the plus that you can wake up anytime you want, and not having to wear a penguin suit like you said earlier before we started recording. So great stuff. Let's talk about macro now, because of course that's the thing you write about, and there's just so much going on, especially now. We also have a very sad war ongoing in Ukraine, but that kind of put extra fuel to the fire in terms of inflation and many of the other things. But let's first talk about bond yields, because like 2 months ago you said, well, I'm comfortable with buying bonds again, U.S. Treasury bonds, because I don't believe yields will go above 1.85. Now they're close to 2.7. Could you reflect back on the trade, and what do you expect of bond yields going forward?
Well, nice of you to put me on the fire straight away. So basically back then I tipped my toes into buying treasuries at 185%. The trade turned into a flattener, which means I sell short-end bonds and I buy long-end bonds. I just want the yield curve to flatten and even invert. So luckily I went out of the outright long bond trade early enough and I turned it into a profitable trade. But the idea was effectively that us central banks here are in a very tight spot. They need to act, and pretty quick, and they need to be seen as acting pretty sharply against inflation to avoid that inflation expectation become unanchored. And what that means is that, Paul, the private sector and the economic agents take their decisions not only based on today inflation, but based on what their purchasing power is projected to be over the next 5 to 10 years. So if the public opinion starts to think and realize that inflation can remain sticky and high, much above the 2% target of the central bank, they might start taking some decisions which are vastly different than they were in the past. For instance, they might start asking for large wage increases. They might start borrowing more, because as they borrow more, the money they need to pay back over 10 years, if inflation is 3 or 4% a year, is in real terms much lower. So inflation basically eats away your liabilities in real terms. They might start taking decisions differently than they were doing in the past. And central banks want to avoid that. They want to make sure that inflation expectations remain anchored. The problem is that when they twist their policy making so hard, like the Federal Reserve did and the ECB is trying to do now as well, in a moment where the cyclical growth impulse that we have seen being very strong in late 2020, beginning 2021, is now watering down a bit, this combination is pretty toxic for the yield curve, which tends to flatten because the front end of the yield curve reflects this hawkish stance from central banks, but the long end of the yield curve is telling you that, this is not sustainable. This hiking cycle, this sharp increase in interest rates cannot be sustained all the way for 30 years, for instance. And so the yield curve tends to basically flatten in. And that was my main take for the first quarter this year. Worked fine. Yields are now skyrocketing as well in Europe, to my surprise, to a certain extent, because we're seeing even Dutch 10-year government bond yields or German government bond yields even reaching higher levels than they reached in 2018, which is an interesting development.
And do you expect yields in Europe then, if we focus on Europe, do you expect them to go higher, or do you expect them to have reach the top at the moment?
So if I use a longer term time horizon, let's say a couple of years down the road, then I would say that the equilibrium rates cannot be much higher than they are today. The reason is pretty simple. Let's take the Dutch real estate market. Let's keep it home, right? So the Netherlands is a place where private sector debt as percentage of disposable income is very, very high. And the result of that is because, mortgage lending in the Netherlands is very active, and the regulation here makes it, relatively aggressive. For instance, in the Netherlands, you can borrow up to 100% of the value of your house, which in other jurisdictions is not possible. In Italy, you can borrow 80%, in Germany, 80 to 90%. 100% is pretty rare.
Yeah. It used to be even much higher.
It used to be even higher, right? So now the so-called macroprudential regulation is bringing it back to around about 100%, but it's still very high. So access to credit, to private credit in the Netherlands is abundant, all right? So people tend to borrow here, and they buy a house and they service their mortgage with income. Now, here's the trick. If mortgage rates, as the result of Dutch government bond yields and in general yields in Europe going up, then also mortgage rates are starting to move up.
Yeah.
If mortgage rates start to move up and don't stop and keep on going up, at some point, the same house you used to buy with a mortgage at 1% and an income of 50,000 euro, 100,000 euro a year, if your income hasn't gone up, then your mortgage installment becomes higher because of higher interest rates, higher mortgage rate. You simply can't afford buying the house at the same price as before. You won't find new buyers able to purchase the same houses if mortgage rates are going higher. What happens then is that house prices have to adjust as well. So the new marginal buyer won't be able to afford the house at 1 million, will be able to now afford it only at 900,000. As house prices go down, the so-called wealth effect also dwindles, which means a lot of people, not only in the Netherlands but across the world, feel that their balance sheet is very wealthy because they look at the liability side of the balance sheet, which is fixed. It's maybe a mortgage or it's a fixed debt against assets that get repriced at market value. House prices keep on going up 10, 15% a year in the Netherlands, in the US. So your balance sheet feels richer, right? So your spending habits become different. You feel much more compelled and buoyant when it comes to your investment decisions. Now try and do the opposite, Paul. Try and do your asset side of your balance sheet, the market value of your assets goes down. How would you feel about that?
Yeah, horrible.
Not so buoyant anymore, much more, conservative. And that's why I think equilibrium interest rates cannot go much higher from here, because otherwise the wealth effect we have created over the last 10 years tends to reverse. And when it does reverse, then the economy tends to slow down as well.
Yeah, I mean, the other day you tweeted something. I have it here in front of me. I thought it was quite telling, actually. There was on the 6th of April, you said, my real estate agent just called to urge me to sell my property in the Netherlands as buyers are becoming reluctant at these prices. Mortgage rates up almost 1% in 12 months in the European Union too. Salaries shrinking when you adjust for inflation, 12% in Holland year on year. Energy costs rising. Did you sell your apartment?
No, I didn't. So the call was very interesting, though. I was discussing with a friend already about real estate prices here in the Netherlands. And let's try to decompose a bit this tweet and talk about it for a second. So I said before that house prices in the Netherlands basically are you can compare them to a bond yield effectively. So you can use the mortgage rate as your bond yield and the house price as the bond price, basically. And then you need to service these coupons of the bonds with your salary. That's what you need to do at the end of the day. And why do I say that? Because in the Netherlands, you can borrow 100% of the value of your house. So effectively, you can treat your house price as the bond price, which is basically the mortgage behind the purchase of this house. Now, if your salary is not going up, adjusted for inflation, and we discussed that it's not going up, because tell me who got a 12% salary increase last year? Can you raise your hand? I don't see anybody.
My friend got an 8% raise the other day, and I laughed at him. Like, look, that sounds nice on paper, but you're still short 4%.
That's correct. So salaries adjusted for inflation have gone down over the last couple of years, let's say, in the Netherlands, but also in the US, also in Germany, in Italy, everywhere, actually. So your purchasing power adjusted for inflation has gone down, right? So that's not good to start with. Now, let's start from a worse situation when it comes to real salary. And then let's try and buy the same house that you were trying to buy a year ago It's now 20% higher in price, on average in the Netherlands, somewhere between 12 and 15, 18% higher in price terms. And now you have to borrow at a mortgage rate, which instead of being for 20 years 1.7% is now 2.7%. So your mortgage installment is higher on two accounts. A, the mortgage rate has gone up by 1 full percentage point. B, the house price is more expensive than a year ago. So your mortgage installment is much higher, to the tune of 25% higher than it was a year ago. And your salary is about 5 to 7% lower in real terms than it was a year ago. Well, no surprise you can't find buyers at the same price. On top of that, energy bills are going up too. So when you buy an apartment or a house, obviously you will want to know how much do you spend for, electricity, gas, etc. That's going up too as a bill. So you incorporate that in your decision making, and you tend to be much more conservative. And now we're at the point where the makelaar, the real estate agent for the non-Dutch speakers, is going to call you up and say, well, if you were willing to sell your property, then you might rather want to do that now as buyers are evaporating. And that's not surprising, really. Long-term, though, Paul, there's a different story. So real estate prices account for this wealth effect for a very large portion on the consumer's balance sheet all over the world. And that's because the real estate market is by far the largest market in terms of market cap in the world. It's not equities, it's not bonds, it's the real estate market. It accounts for 57% of global wealth. Now, GDP growth has been very sluggish over the last 10 to 20 years because productivity trends and demographics are pretty shallow at the end of the day. The way we're using to feel more wealthy is indeed to make asset prices go up, up, and up, and make borrowing very cheap for new people to be able to enter these markets even as prices go up, because they can borrow cheaper and cheaper and cheaper. And that's why we're keeping this sense of wealth with us.
It sounds like you're describing a Ponzi scheme.
Pretty much. I mean, a Ponzi scheme is in this case, what we're doing here is we're valuing the asset side of our balance sheet. So all the assets we own, bonds, equities, real estate, gold, you can look at any asset over the last 10 years. It has gone up in price. So it has made our asset side of our balance sheet much stronger, while the liability side of our balance sheet, what we borrow basically, that's at a fixed rate, and it's becoming cheaper and cheaper and cheaper to borrow. So naturally, these lower interest rates adjusted for inflation, so real yields, this is the trick. When real yields drop, then basically you're making the real cost of borrowing cheaper, and you are making the assets on the asset side of your balance sheet more expensive, more rich. That makes you feel wealthier effectively. If you try and reverse this mechanism, that's very painful. It's a deleveraging mechanism that nobody wants to go for.
Yeah, so the real yields need to get lower and lower and lower in order to keep the game going. But now we've reached a point where nominal yields couldn't get any lower because they've reached the zero bound. And real yields, of course, can go lower if inflation takes up or goes up. And that has happened, of course, over the past few months. Mm-hmm. But then you get the central banks and they see the situation that they feel like they need to do something. There's a lot of political pressure on them. So they start acting. And then we see yields going up. But then asset prices can or will crash. We saw the bond market crashing. We see already in Holland that over the first quarter, the house prices are going down.
Yeah.
So that's, of course, also not a very happy outcome for policymakers. But let's assume that the yields will go up a bit further. What is you think a sustainable level, or a level where the policymakers can still live with?
Yeah.
Is it 3% or 4%
so
long term?
Basically asking for a thing which is called neutral rate or equilibrium interest rate. It's a theoretical rate we can't observe, but we can try to estimate. And it's a rate at which the economy runs at its potential. It doesn't overheat, it doesn't cool down, there is no recession, there is no overheating. The economy just runs at its potential. And these neutral interest rates in Europe, in nominal terms, I estimate it to be below 1%. So around about 0.5%, right? So now if you look at 10-year German government bonds, they're already above this level. Dutch government bonds are already above this level, which means that the situation, the market is reacting to the central bank telling you that they want things to slow down. They want to bring rates to a restrictive level where borrowers will think twice before borrowing more. And, increasing aggregate demand in the economy. They want things to slow down. It's a temporary cyclical exercise. As things have gotten overheat, basically, they want them to slow down. So they will make sure that nominal yields go above these equilibrium interest rates. So they trade restrictive for a while, then things cool down. That's their plan at least. And then, they can basically reassess from there, and hopefully inflation will have cooled down as well if things tend to cool down in aggregate in the economy. Now, there is a risk in this strategy, which is that you tighten too much. If you bring interest rates way above neutral rates very fast, then you risk that an over-leveraged economy suffers quickly. And then house prices don't cool down, they go down by a lot. And the same with equity prices and with bond prices. And we are now at crossroads, basically. We are now in a situation where we need to be very careful with this exercise. And it's not going to be an easy one.
Because inflation is proven to be quite persistent. What if it stays at elevated levels for maybe years to come? Then they should raise rates even higher, but then you will crash the economy.
That's correct. So there is no easy way to handle this. The positive case scenario is that central banks can engineer a so-called soft landing, which is extremely difficult to achieve, in which you bring interest rates just above neutral levels for a while. Things cool down orderly, including asset prices. You have an equity drawdown of 10%, house prices drop 5 to 10%, inflation starts to go down aggressively back to the 2% inflation target. And once they're sure that they've basically cooled down things enough, they can start, easing a tiny bit again. It sounds all cool and dandy, right? But it hardly works this way. And it hardly works this way because, first of all, we don't know what neutral rates are. So it's very difficult to basically calibrate this exercise in such a smooth way. And second is, the higher the leverage in the economy, the higher the risk-taking activity you encourage. When interest rate, where borrowing rates in inflation-adjusted terms are very low, people, tend to go after it. They borrow up, they buy second houses, third houses, they rent them out, they use the equity in the second house to buy a third and a fourth and a fifth house. You basically tend to lever up when volatility and real interest rates are very low. And the longer this lasts, the more you will want to join the party and lever up and go after these returns. But as you lever up and things have to slow down, the risk that this high leverage plays against you and the reactions are not linear anymore increases over time. And you can see that because in 2005-06, the Fed could bring rates all the way up to 5% before something, started to show some cracks. And there was the real estate market, and then we have the great financial crisis. After the great financial crisis, there was no hiking cycle in America, and basically also in Europe, all the way until 2016, 17, 18, which was the last hiking cycle in America. It didn't stop at 5% anymore. It stopped at 3% this time, shy of 3%. Why? Because leverage between 2008 and 2018 went up by a mile, which means the private sector can take much less heat before things start to unravel in a negative way. Leverage has increased, buoyant activity, animal spirits out there, taking risks, levering up, which means you can afford a much less harsh hiking cycle than you could afford before. And the reactions are not linear anymore. They are convex. They are non-linear. So you need to be very careful here.
Yeah, so every credit crisis we try to solve with even more credit.
Correct.
So it's, I celebrated my son's birthday over the weekend, and it was on a Saturday, and he was doing a great job, primarily also because we fed him with a lot of sugar. So he was a start all day, but the next day it's horrible.
Yeah.
Because he had a hangover, of course, because of all the sugar the day before. And it feels to me like we are the economy is like this drug addict that we try to revive every time with more dope. And then in the end, every time the crash is even bigger and more dramatic.
Paul, the sugar metaphor is great. I actually tweeted a while ago that for every credit sugar rush, there is always a credit sugar cliff after that. So during the rush, we basically have banks lending to the private sector in an aggressive way, a lot of credit demand from the private sector because it's very cheap to borrow. That's when volatility is low, real interest rates are forcefully very low, and economic activity is picking up. Basically, I am describing late 2020, beginning 2021, when we had central banks making sure volatility was suppressed. We had real interest rates very, very low. In Europe, deeply negative. In America, deeply negative. Mortgage rates in the Netherlands for 30 years were below 2% in nominal terms, which means in inflation-adjusted terms, you could borrow for 30 years at a foreseeable negative real mortgage rate, inflation-adjusted mortgage rate.
I have a 10-year rate of 1.2, for example.
Can you imagine that? So basically, you're getting paid in real terms to borrow. At the time where economic activity is picking up, the cycle is picking up. We are about to produce a vaccine. We then produce a vaccine. We limit the downsides of the pandemic. It's great. You borrow up, you lever up. It's animal spirits. It's all over the place. And that is the credit sugar rush. On top of it, especially in the US, the government said, okay, here you go, guys. I'm going to throw at you money. And we always talk about central banks printing money, but central banks print a form of money that can't be used in the real economy. It's bank reserves. Yeah. We can talk about that later if you want. The government prints literal money. They are the monopolist issuer of the currency we use. And when they say, I'm going to send you a check, they literally create the money out of nowhere. They make a deficit, so-called budget deficit, and they say, look, I don't have this money, but I can print them. So here you go, Paul. Here is a check in your inbox. And the US government, and also in Europe, by the way, we did a large amount of fiscal spending. Even when the economy was already running and restarting a cyclical growth engine, we still kept on throwing new resources to the private sector, new credit to the private sector. It was a huge credit sugar rush. I have a metric that measures the impulse, the acceleration in this credit creation, Paul. It was the strongest ever global concerted credit sugar rush that we have ever seen over the last 40 years, all compressed in a year and a half.
Yeah.
Credit sugar high at its best. Now we're facing the other side of the equation. When is the last time that the Dutch government or the US government or whatever other European government threw net resources at the private sector? Somewhere in 2021, beginning of 2021, maybe mid of 2021. Now it's the opposite, actually. Governments are starting to rein in their spending. They're even increasing the tax base. They're asking private citizens to or restaurants or corporations to pay back some of this fiscal spending.
Although at the same time, we see a lot of governments in Europe, of course, proposing to compensate citizens for high inflation. Yeah. So I believe, especially in Europe, and I want to get your take on that, is that governments are so used now to run up large deficits and to completely disregard Maastricht Treaty norms, whether it's Corona or it's the war or it's inflation or it's climate change. They always find reasons to keep running high deficits because they don't feel restricted anymore, because they know in the end Lagarde will be there to pick up all the debt. You're Italian. Mm-hmm. Earlier in the conversation, you talked about Italian flexibility. Yeah. Well, Italy was also famous for its monetary flexibility. Yeah. Do you think that the euro is on a sustainable trajectory, also given everything we just discussed with the credit sugar rush and the inflation?
So the architecture of the euro is horrible, and I am not breaking new grounds here. I think it's clear to everybody that if you have a monetary union without a fiscal and a banking union, it's a very difficult architecture to maintain, because basically fiscal policy in 18 countries can be extremely different from each other. And calibrating one monetary policy for 18 different countries is also extremely difficult. So it's a very fragile equilibrium that holds together as long as there is credibility that euro is going to be the currency where everybody stands behind for, right? And we have had a couple of episodes where that was not that clear anymore. But Europe seems to be one big machine that sort of needs to get into deep trouble before trying to reassess themselves. And now we have come up with this, first somehow fiscal union issuance, which was the SURE program and the EU, the European Union, issuing on behalf of the countries effectively. The next generation funds. There are a couple of questions there. The first is the continuity of this project and the size of this project. The second issue I see is that debt and fiscal deficits are demonized in Europe like they are nowhere else. And that comes from historical heritage of Germans, Austrians, in general, let's say German-influenced Northern European countries that have had massive troubles in the past with fiscal deficits that has caused hyperinflation. That's, I'm talking about the Weimar Republic and similar episodes that happened in the past. And if you just look at basic economics, you understand that fiscal deficits are basically assets thrown at the private sector. So it's an identity, undeniable economic identity, that if the government spends with fiscal deficits, the private sector benefits from these fiscal deficits. So it's not bad per se that the government produces debt. The question that we never ask in Europe is, what is this deficit spent for? What is the productivity of this newly created money out of the government balance sheet now going into the private sector balance sheet? What are we using these funds for? That's the real question.
Yeah.
And we skip this part often in Europe, and we move to, there must be rules limiting the extent of fiscal deficits. The real rule, if you want to put one, should be how productive are the fiscal deficits we create. Because if you starve the private sector with assets coming from the public sector, you know what happens? The private sector will try to lever up by themselves.
Yeah, so you're describing modern monetary theory in a way, like how...
Part of it.
Yeah. But what do you make then of the argument usually levied in the North that a lot of money is being wasted, for example, in Italy or some of the other peripheral nations? What do you think of that argument?
So the productivity of fiscal deficits is generally pretty low because there is not enough discipline and not enough checking on how do we spend the money basically that is created by the government. This money is thrown at the private sector, but it's not targeted. It's not a highly productive credit creation. And there is no check basically on how productive this credit creation is. So yeah, the answer to your question is most of public sector credit creation, so fiscal deficits, has been proven to be unproductive. That's not only in Europe, but all over the world.
Yeah.
Now, the flip side of that is that certain countries, like, for example, Finland, Austria, the Netherlands, Germany, they've chosen to be much more conservative when it comes to government credit creation, so fiscal deficits and debt. But people are forgetting to look at the other side of the equation. Private sectors in these countries are generally much more levered than they are in Italy, Spain, France, and other countries. And that's because when the private sector doesn't get resources from the public sector, take the Netherlands, for example, the public sector is very conservative in how it handles its public finances, the public sector. Yeah. The private sector, on the other hand, has ample access to credit. So it tends to lever up to buy houses. And then obviously the leverage in the private sector tends to go up a lot, which makes countries like the Netherlands more exposed to a housing crisis than Italy would be, for example. Italy, on the other hand, makes plenty of use of the public sector balance sheet in a rather inefficient way. So the result of that is not reflected in higher GDP growth, but the private sector is not that levered at all in Italy, for example.
But that's a cultural difference.
Correct.
Also. And then if you, I guess if you live in a nation or a geography where people share the same language and the same culture, it's also more easy to verify that the spending is done in the most productive fashion. I think for a lot of people living in the Netherlands, for example, they have no clue and they cannot really easily verify how money is being spent in Bulgaria, for example, or in Italy or whatever. So that structural issue will pertain for the future of the euro. As long as we don't share a common identity, a common language, a common culture, we will have this problem.
Look, Paul, the reality is that the euro is a geopolitical imperative, and as we are seeing now, European countries are net importer of energy, and we need energy, and the energy transition towards net zero will require a transition period where we still need oil and non-ESG-like sources of energy that we will keep importing from other countries and other jurisdictions, unfortunately from Russia in this case. And nevertheless, I mean, in that situation, the euro and the cohesion of the entire bloc that is able to negotiate these energy importing contracts, for example, other sort of imports and exports as Europe rather than single countries within Europe is a geopolitical imperative. It basically gives you a certain bargaining power you wouldn't have if you would have to negotiate these deals as Germany, Austria, Italy, France.
But in the end, we see Germany flying to Norway to negotiate deals. We see Bulgaria trying to. I think they were able and ready to use rubles to pay for gas. So we don't see Texas doing that, and we don't see North Carolina doing that. So this unity, even in the deepest of crisis, we miss this unity.
In the deepest of crisis, you'll get something done, and I think the proof once again was the next generation funds. I mean, I always say COVID was the perfect exogenous storm that could have destroyed the euro, and also could have basically, hit hard this wealth effect model that we have built since the 80s till today, because politicians could have said, look, it's an exogenous shock. It's not my fault. I can't do anything to contain that. So I let equity markets reprice 60% down and the real estate market collapse and all of that. I'll let the euro break down and I'll let Italy figure it out and Germany figure it out by itself.
But no politician wants that on its own record. Right?
And no politician wants that on its own record. There's no elected politician that will choose to
sink the ship.
Well, intentionally unwind this wealth effect mechanism we have seen over the last 40 years. Because if you unwind that, what happens is that you wipe out the wealth accumulated by a couple of generations, and then you revert back to a situations where there is a massive deleveraging that lasts for a decade maybe, till the dust settles. So when the dust settles, you'll have to start growing. If you don't want to lever up again, you will start growing in GDP growth based on your structural trends, demographics and productivity. Yeah. Those are the two long-term drivers of economic
and they're
growth.
Both not really good.
I'm sorry, but the birth rates are dropping and you're not going to make them go up by wiping out the generation of two, wiping up the wealth of two generations. So you'll end up growing at 1% a year, which nobody's happy with, after you have destroyed their balance sheet completely. So there is no elected politicians that want to go for that. So it's going to be kick the can down the road for as long as we can.
And there are Asian and American commentators that sometimes describe Europe in the future as just one open-air museum, but not much else to do. But what do you make then of this announcement of Lagarde that she will use all tools needed? It sounds a bit like whatever it takes to make sure that the spread between Italian and German bonds is not going up much higher. So effectively, she's talking about yield curve control, financial repression. What is the level that she's going to control? She's going to try to control the yields of, let's say, Italy.
So she's looking at two things. First, at BTP Bund spread, so the spread between Italian government bond yields and German government bond yields. That is a metric of trust from foreign investors, basically relative trust on the Italian public finances against the German public finances. And she's also looking at outright bond yields in Italy, because Italy will need to refinance a large amount of debt over the next few years. So she is careful about the levels, the yields at which Italy will need to refinance this debt load, basically. Because then there are discussions on debt sustainability when it comes to Italy, right? And she wants to avoid this discussion even start. As I said, fragmentation is the real risk, and euro is a geopolitical imperative. And especially at this stage, as we are dealing with the energy embargo, basically, from Russia, the euro bloc can't be seen as shaking. So she's trying to basically provide with a put, or provide with a level at which she would feel very uncomfortable, which would signal investors she's ready to intervene, which would make them much less brave in pushing above that level.
But at the same time, she said she would. They are talking about unwinding current QE,
indeed,
but because of the high inflation. But if at the same time she starts buying
it's not
bonds again, you cannot have the cake and eat it.
The difference between this monetary policy setup and macroeconomic setup and the ones we have seen over the last 10 years, where Draghi and Yellen and all the other large central bankers could just come in and do QE, is that if I look at inflation expectations in the Eurozone today, over the next 5 years, they are already much above the 2% inflation target. If you do QE on top, even if it's a QE, not QE, just to backstop BTP Bund spreads, for example, the signal you send, it's not a positive one to make sure that inflation expectation don't become the anchor. It's actually on the wrong side of the equation, if you ask me. You should remove accommodation, not increase accommodation, if you want to make sure that inflation expectation become the anchor. Draghi never had that problem. Inflation expectation under his mandate were always too low, so he could even say, well, I'm trying to boost inflation expectation by making Italian borrowing costs cheaper so that Italians can borrow more and can make economic activity run, etc., etc. Lagarde can't say that now. So she's basically trying to provide an out of the money sort of line in the sand where she says, look, guys, I mean, if you go to, she didn't say a number, she can't say a number, but if you go to 250 basis point over Germany when it comes to BTP, Italian government bond yields above German yields, I'm going to feel uncomfortable with that. I'm going to start and step in. But it's A, far from where we are today, till the moment she, I think, is ready to intervene. And B, it's really not credible because of the monetary policy and macroeconomic setup we are in, which is pretty unique.
Yeah, so she is just praying to God that inflation will go down a bit in the coming months. And because I read somewhere that Italy should still be fine with bond yields, 10-year yields for Italy around 4 or 5%. They should still be able to manage. Do you agree, or what's the pain level for Italy?
No, not really. So if I look at last time I checked this a while ago, so don't take take numbers with a pinch of salt. Last time I checked, the average weighted bond yield, or let's say cost of carrying Italian government debt and refinancing that was locked at about 2.7%, 2.75%. So as bond matures, if you need to refinance that and yields that are higher than 2.75% in nominal terms, you will increase the average borrowing costs on your debt, right? Now, obviously, inflation has changed since then. So as a borrower, it's important to look at real interest rates, because you will pay a nominal coupon on the bond, right? But inflation in the meantime will eat away the real cost of your debt. So if Italy borrows €1 million and inflation is 10% this year, then next year the €1 million Italy has to pay back is worth much less because of 10% inflation, right? Even if they had to pay a coupon of 1%, they're still better off, right? So if you look at inflation adjusted borrowing costs for Italy, then things still look okay-ish. But in that calculation, it assumes that 4 or 5% nominal yields are still fine for Italy. You're assuming that inflation remains very high for a long period of time. So I think you need to be careful, as Italian 10-year government bond yield are already at 2.5% as we speak now. Yep. And things are, I don't think the ECB has already turned as hawkish as they can turn. Imagine if inflation doesn't fall according to their plan. Imagine if public opinion starts to get more worried about it. It starts to ask for higher wages, which we haven't seen yet happening. Then I think they have to send a stronger signal. How can you send a stronger signal you're removing accommodation if you're talking about the facility to backstop BTP Bund spreads? It doesn't square.
No. Man, I'm glad I'm not a central banker, to be honest. What I also never have understood, and I'm glad I have the opportunity to ask you, why are these pension funds, have these pension funds for years been buying these negative yielding bonds and basically squandering, wasting my money and that of many other pension holders? Like, what's going on there? Is it regulation that, like the liquidity coverage ratio that you described earlier, is it regulation why they're doing that, or because it's not really it doesn't seem to help us as citizens?
So pension funds and banks are highly regulated entities, Paul, that are required to purchase bonds in large portions, because bonds are considered to be A, liquid instruments, and B, they serve another purpose that people often overlook, which is they hedge interest rate risks on the liability side of these entities. Let me try to explain. It sounds difficult, it's not. If you're a pension fund, you have liabilities, which are pension contributions you need to pay out to your citizens somewhere like 40 years down the road, 30 to 40 years down the road. Your average contributor is 35 years old. He will retire in 30 years from now, let's assume, right? So you are running a risk, an interest rate risk, that interest rates move throughout this 30-year period's time, right? And so if you want to hedge this risk on the asset side, you lock in interest rates for 30 years. So you have a 30-year liability and a 30-year asset, and you are hedged with interest rate risk. Now, so it means that if interest rates move up, your liabilities go let's say, down in value, which is good for you, but your assets also go down in value, but you're hedged. So net, nothing has happened to your capital, to your balance sheet position. Now, this used to be very convenient for pension funds like 20, 30 years ago, because they could also lock in a yield on the asset side by buying 30-year government bonds, which was 5%, 6%. So that was great also for returns. And nowadays, pension funds are still required to hedge interest rate risk to a certain proportion. And in order to do that, they have to buy some bonds. So they are forced to basically use these instruments to hedge their interest rate risk. But from a return perspective, they contribute negatively to pension fund returns. In order for pension funds to hedge interest rate risk and get a return on the asset side with bonds, they need to buy junk bonds. They need to buy mortgages repackaged into a bond. They need to take additional risk, which is what they're doing. They're buying equities, they're buying CLOs, they're buying mortgage-backed securities, they're buying credits, they're buying anything they can get their hands on, because the population is aging. And so these liabilities are becoming, let's say, longer and longer, because people die at 90 now, so they retire at 67. So it's becoming stretched out on the liability side. And on the asset side, you need to generate a larger and larger return to meet these projected liabilities, or you have to cut pensions. And again, which politician is going to volunteer to have pensions entitlements cut under his tenure? Nobody will.
Yeah, that's too bad. We always vote for very short-sighted politicians. We are nearing the end of the interview, and they're cooking some delicious meals in the kitchen, so it's very difficult for me to concentrate with what's reaching my nose at the moment. But I want to end this conversation with the macro endgame, because that's a beautiful article you wrote in January. And recently we also had Sultan Posar's analysis about Bretton Woods 3. Yeah. We have a few minutes left. Could you, especially given what's going on right now in the world and the deglobalization and a new Iron Curtain perhaps between BRICS countries and G7 countries, how do you expect the financial system to evolve? What is the macro endgame?
So the macro endgame is the moment where the kick the can down the road model we are applying of this wealth creation and lower real interest rates comes to a halt. And it's very difficult to project when that is. And I mean, I heard people call for this 20 years ago, and we still have done the good old model of borrow cheaper.
Guilty.
And borrow cheaper, make your asset side of your balance sheet more expensive, and rinse and repeat, create this wealth effect mechanism. There are few signs we are at some bottlenecks. One, you mentioned it before, and it's that real interest rates need to be marginally cheaper every single time to make the access for the new borrower doable. Even if house prices or equity prices keep on going up, you can borrow cheaper and cheaper and cheaper, right? And real interest rates can go down if nominal yields go down or inflation expectation go up. Inflation expectation are already at the point where central bankers are a bit unhappy with it. So nominal yields are very close to the lower bound. It's getting trickier for this to happen, but central banks always have a trick. Policymakers always have a trick. The trick is CBDCs, central bank digital currencies. With those, basically with a complete cashless economy, you don't have the lower bound constrained anymore on when can I push nominal yields lower. Because if you push them below 1%, people might say, sorry, I don't want to pay 1%. I'd rather have cash in my pocket. I'm going to pay some storage costs, some insurance costs, but it's going to cost me less than negative 1%. If you remove this constraint and you allow people to have a full digital cash equivalent, basically, and the central bank can apply directly interest rates to a tier of the population via CBDCs, and they can say, Paul, for you it's minus 3%. I want to withdraw cash. Sorry, there's no cash anymore. It's minus 3%. In that case, central banks might be able to engineer real interest rates continuing to go down even further. It's becoming stretched, though. So we are at the point where I think, in general, having a portfolio that offers some asset classes that can react in a convex, positive way to such a crossroad bottleneck getting closer is something very sensible to do. And I think of these asset classes in two terms. One is asset classes that benefit from a restructuring of the monetary system. That doesn't mean the sky has to fall apart. It means that people start to debate whether a fully elastic fiat credit system, which is what we have today, is ideal or not. And when they do debate an alternative, they normally tend to go back to a place where credit creation is pegged to something. And that something used to be gold. Has been gold for a lot of times throughout history. And gold already sits on the balance sheet of large institutions, sits already on central bank balance sheet, on government's balance sheet. So it immediately will play a role in this potential discussion. So if you own some in your portfolio, it might help you actually preserve some purchasing power if we get closer to that bottleneck.
What kind of percentage you're thinking of?
I myself own 8% gold.
8%.
But anybody actually should own gold given the risk tolerance. And the risk tolerance is, different. Don't forget, gold doesn't produce cash flows. It's an asset that it's a monetary asset, effectively, a precious metal that doesn't produce cash flows. The other asset that I think can benefit from this is productive real estate. So I always think of farmland or residential real estate, because ultimately you can't print new land or you can't print effectively into existence new real estate. And real estate also plays a role, a utility role for society. So whatever monetary system we choose, whatever new alternative we choose, you will still have to have some farmland and some real estate. So if you can own some of that, I think it also makes sense over the very long term. And so some exposure to these assets, I think it's sensible to have in the portfolio.
And crypto?
Well, digital assets are, I hate the polar discussion that there is. It's either worth zero or it's worth $1 million and there's going to be a Bitcoin standard. I think it's not the right way to approach it. The world is fast moving towards technological advances. I mean, we're becoming permeated by technology. And digital assets and digital ledgers actually do play a role and will play a role together with blockchain as we proceed further. So owning a basket of digital assets as well in a portion of your portfolio that doesn't make you freak out when there are drawdowns also makes sense. So it should be commensurate to your risk tolerance, but digital assets might play a role as well when we start discussing, is there a better alternative? Is there a better, more sustainable monetary model that can replace the fully elastic credit fiat system? So I wouldn't demonize them. I wouldn't think we will buy bananas in Bitcoin next year and that will be the only way we can transact. I think there is a middle ground where you can sensibly own some of these digital assets in your portfolio too.
Well, I like your nuanced view. That's very much appreciated. We've reached the end of the interview, but could you advise our listeners to what's the best book they can currently read if they want to understand the current and the future monetary system?
I think the last book from Professor Steve Keen, it's called The New Economics Manifesto, I think. Again, don't quote me, but let's check it out, put it in the show notes maybe. Last book from Professor Keen is very good. He's an eminent economist, Australian economist, who understands the monetary system very well and speaks of private sector balance sheet and public sector balance sheet and who creates money and who doesn't create money. So you can get an understanding of how the building blocks of our monetary system work and therefore start connecting dots better.
Yeah, Steve is great. I had the pleasure of interviewing him a few times on this channel. I also read Debunking Economics and all the other books. So I haven't read this one yet, but great advice. I will definitely buy it and read it. Thanks so much, Alfonso, for this interview. And where can people find you? It's MacroAlf on Twitter, right?
Yeah, so the Twitter handle is @MacroAlf and the newsletter is called The Macro Compass. It's free, guys. There's no charge. So just go and check it out. Subscribe if you want. It's on Substack. We'll put maybe a link in the video. Yeah. The one last thing I need to say is that we recorded the interview in the restaurant called Due Sicilie. It's in Amsterdam on the east side, close to the Amstel station, easily reachable. Guys, I mean, this is like eating at my grandma's place. Yeah. It's amazing. Customer service, the top you can have. Food is awesome.
It's nice and cozy. It comes across as very Italian, very authentic. So.
I mean, if there is one place I need to go and eat, it's always here when I want to eat, when I want to feel home, literally. Yeah. So if you want to try Southern Italian cuisine without having to take a flight to the Amalfi Coast, you can straight away come here. Le Due Sicilie. I mean, these guys are great.
Yeah, thanks again. Oh, wanted to give a kiss, but then I bumped my microphone for the hospitality. So, Alfonso, thanks so much. And let's keep in touch.
Thank you, Paul.